when the economy picks up, we have more earnings. If we have more earnings, we start investing. If we start investing, we tend to go further out the risk curve. This applies to the same. I could put alts here. This is the ETH Bitcoin cross. I could put any variation of alts on here, and it works. It works in small caps, it works in the credit market, it works in all the same across all markets. So it's super consistent. It's just a macro asset that happens to have higher returns than anything else. Bitcoin dominance, same chart, driven by the business cycle. And when we see the business cycle put against Bitcoin, you can see the tops and bottoms pretty much match as well. So it's not voodoo here, you're looking for the tops and bottoms. Now the question you need to ask yourself is, does it look like the business cycle is topped here, or is it still bottoming?
The starting point for everything Raoul explains is debt. Global debt levels are now so large that interest payments alone have become unsustainable. Governments are not just borrowing money, they are borrowing money to pay interest on previous borrowing. Over the next 12 months, roughly $8 trillion must be printed or injected into the system just to service interest payments. This is not optional. There is no alternative. Governments cannot cut spending fast enough, cannot raise taxes enough, and cannot grow fast enough to escape this reality. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support. Let's continue.
Here is global liquidity and interest payments. The interest payments are obscene going forwards. And the only way of doing this is printing money. So here gives you a chart of the money printing ahead. We've got about $8 trillion of money to print via liquidity in the next 12 months. And I know a lot of you think that the crypto cycle might be over and we can't have nice things. I'm going to show you we can have nice things. You just need to learn patience. And this is the chart. Will it map absolutely perfectly every time? Sorry, I'm one chart behind here. Will it match every single time? No, but it will match over time. So that's the really important chart here. What's driving all of this is actually the cyclicality, not from the Bitcoin halving cycle, some mythical cycle Satoshi handed to us from the gods. It's actually driven by debt maturity cycle. The debt maturity cycle from 2008, what they did was issued all of the debt at 0 interest rates between 3 and 5 years, and we've been rolling those debts ever since. And the debts keep increasing because of the interest payments, so we keep adding liquidity to service the debts. So the interest payments are the thing that's causing the cyclicality. So when we look at the chart of the ISM survey, the business cycle, and we look at the 4-year sine wave, we can see the cyclicality of the economy driven by the debt cycle. It's perfectly cyclical until the last year. And the last year caught everybody off guard because we didn't get the massive liquidity injection. And I started doing the work thinking, why the hell didn't that happen? And I realized they've actually moved the debt out to 5.4 years. In 2022, they extended maturity because rates went back down to 0 again. They extended maturity, so it's extended our cycle. So it's not a 4-year cycle now, it's a 5.4-year cycle. So when you have a 5.4-year cycle, we get this. So we're through the trough of the cycle, and the next is the rise up. And the cycle should peak at the end of 2026, not 2025. And I've been stressing this a lot, and people haven't really got an understanding because they think it's just a magical cycle. But it's not. It's all driven by macro, it's all driven by demographics, and it's all driven by the debt cycle. And that's the one breakthrough that we had at Global Macro Investor, is understanding that crypto is actually a macro asset. Once you understand this, you understand what drives it. So it doesn't become this voodoo thing where you need your hourly charts. You have a clear framework of understanding, all based on the demographics, the business cycle, and all of those things. You see, once you detrend Bitcoin, it is exactly the same as the ISM survey, which is the business cycle that drives all assets. When you do it, it's actually, you can see it's actually discounted more than the business cycle right now. Now, do we get another weak ISM print? Maybe, because of the shutdown, but maybe not. But I'm going to show you why it's going to be more positive going forwards, and that's the hopium part. But the point being, it's all driven by the business cycle. The business cycle is driven by liquidity. And it does it for all other assets too. The Russell 2000 is the same. Crude oil is the same. Industrial metals, all the same. Every single asset is driven by the business cycle, because the business cycle is the earnings of the economy and where you invest. The industrial metals is driven by when corporations make more money, if the economy starts booming, they start demanding more metals. Same with crude oil, same with all of this stuff. Same with the risk curve. The Russell 2000 is basically small caps. Well, as the business cycle picks up, people have more earnings, they go further out the risk curve, it helps the smaller companies, their P&L goes up, and it's all driven by the same thing. But it also drives our beloved alts season. So here's the ETH Bitcoin cross, and it's driven by the business cycle. Why is that? Because when the economy picks up, we have more earnings. If we have more earnings, we start investing. If we start investing, we tend to go further out the risk curve. This applies to the same. I could put alts here. This is the ETH Bitcoin cross. I could put any variation of alts on here, and it works. It works in small caps. It works in the credit market. It works in all the same across all markets. So it's super consistent. It's just a macro asset that happens to have higher returns than anything else. Bitcoin dominance, same chart, driven by the business cycle. And when we see the business cycle put against Bitcoin, you can see the tops and bottoms pretty much match as well. So it's not voodoo here. You're looking for the tops and bottoms. Now, the question you need to ask yourself is, does it look like the business cycle is topped here, or is it still bottoming? It's a simple question, and the answer is going to be, well, it probably looks like it's bottoming as opposed to topping because it's still below 50, so the economy's not growing.
So why has crypto underperformed recently? Liquidity plumbing broke. In mid-year, the U.S. Treasury refilled its general account, the government's checking account. Normally, liquidity is drained via reverse repos, but the reverse repo facility was already empty. So liquidity was pulled directly out of the system. Crypto, being the furthest out on the risk curve, got hit the hardest. This created what Raoul calls alligator jaws, a sharp divergence where assets like the Nasdaq held up while crypto collapsed.
And going ahead into an election cycle, Scott Bessent, who I've known for a very long time, a macro guy, and Donald Trump and everybody else tells you they're going to goose the economy, both with liquidity and fiscal stimulus, because they want it to grow for Main Street. Why? Because they want jobs. They want Main Street to feel happy, so they will vote for them. So it's the political game tied with the fiscal game, tied with the monetary game. That's all coming. That all lies ahead. So let's look at Bitcoin and the liquidity cycle to understand that. It is the most dominant factor. Essentially, it is the single most dominant factor in all of markets I've ever seen in global macro. It's the easiest macro environment of all time. It's driven by this one cycle. We know how long it is. It's driven by the debt cycle. And we know that they print money to deal with it. And Bitcoin has a 90% correlation. Nasdaq has a 97.5% correlation. We've never had a macro factor so dominant. Nothing else matters, which is why I always say it's all noise unless you're talking about liquidity. There's noise in liquidity, and we'll come on to that in a sec, but that's really the factor. Where are we in liquidity? Well, this looks a lot like the ISM cycle, doesn't it? It's a bit subdued still because we haven't needed to print the money for the final part of the debt refi cycle, which happens in 2026, not 2025. So we've seen liquidity picking up, but it's not accelerating yet. But we're seeing the changes to the plumbing system. We've seen the Federal Reserve cutting rates. We've seen the SLR, the supplementary leverage ratio rules being relaxed to try and allow the liquidity to come because they got to roll the $10 trillion of debt. We saw those interest payment charts earlier, $8 trillion just to service the interest rates. When we use financial conditions, which is our forward-looking indicator based around the dollar, rates, and commodities, it actually leads total liquidity. So we've got a forward look here by another 3 months of where total liquidity should go. So that's pretty useful. We know that probably the dollar is going to weaken, and that will drive financial conditions further, which means it pushes the cycle out even further. So the cycle looks like it's going well into late 2026. When I look at it versus the ISM survey, it leads that. So now we've got this perfect dominoes of which we understand. We've got the forward-looking stuff. We've got the liquidity that matters to us in crypto. And then we've got the business cycle, which matters to us here at Solana, because we'll be driven more by that than we will by the other parts of the cycle. So that's all to come. The economy is going to strengthen, liquidity is going to come, and it's all written. But right now, we're all suffering from these alligator jaws. Suddenly, something broke in July and double broke in October. And that was liquidity again. It's always liquidity. Liquidity is everything. And what happened was the Treasury refilled the general account. And that's their checking account. And that sucked liquidity out of the system because normally it's drained by the reverse repo. And the reverse repo was already drained. So that took liquidity out of the system. Crypto is the furthest out the risk curve. It gets hit. And so as they suck liquidity out, the thing that requires the liquidity the most, crypto, falls. The NASDAQ didn't do as much because people were underweight the NASDAQ. 88% underweight versus benchmark. They were all performance chasing, so that brought that. But Global M2, the famous chart, and I said this is not going to work all the way properly, but over time it will get right. We've got the alligator jaws because of what happened in July, and then the government shutdown. We've had no liquidity in the system. That liquidity is coming back because they've told you it is. The changes to the SLR allows them, the banks, to maybe create $3 trillion worth of liquidity, maybe $5 trillion. That's coming. It's all coming. But what we've got is a gap. And as I said before, NASDAQ doesn't have that gap. It followed M2 perfectly. It's a crypto-specific thing, not because we can't have nice things. It's because we are furthest out on the risk curve. So when liquidity is being drained from the system, we get hit the hardest. The reverse of that is when liquidity comes, we make all the money. That's the game we play. And so we create all of these narratives around this space, and it's somewhat ridiculous when it's so macro-driven. We can see another one of the alligator jaws, NASDAQ. They've had the nice things, we haven't. The probability is that when liquidity comes back properly into the system, we will play catch up. Gold lives in financial conditions world in the future. We've diverged from the gold chart, which has been doing a great job. Same issue. We've lost the liquidity. They're living in the future. Everything is fine. Historical parallels, which are working really well. Alligator jaws everywhere because of this one specific liquidity problem. It's not the end of the cycle because we haven't even really started the cycle yet. It's driven by this liquidity issue of the plumbing of the financial system. And I know it's a bit complicated, but it is basically just that. More historical parallels, more alligator jaws. Here we've got the economic surprises index, how economists forecast the economy. The economy's been okay, but Bitcoin has really not liked it. We've got an excess fear gap. We've got now the fear, and after October, we've really got the fear. We're pricing in terrible outcomes. We don't ever believe it's coming back. This doesn't make sense from the macro perspective. We see it versus financial conditions. The excess fear gap is still there. We see it everywhere, and that fear gap should close, and it should close in the direction of the economy going higher, liquidity coming, and crypto chasing that. The problem we've got is this magic formula where population growth, productivity growth, and debt growth drive economic growth. They drive economic growth, but we've got a problem. The first driver of that is population growth, and that's been falling. The labor force participation rate, the number of people in the workforce, well, if we extrapolate forward, it's going to keep shrinking. That means the economy is going to keep shrinking over time. This is a structural problem in every Western country, also Japan, also China, not here in the UAE, but elsewhere. We've got this problem. This is the big one. Also, the important chart behind that is the fact that that labor force participation rate, i.e. the fewer people in the workforce, that demographic is what drives debt. This is the most important chart in macro. I talk about it all the time, and it hasn't yet been copied on Twitter, so therefore nobody understands it. But this is the chart that really matters. What it's saying to you, we knew from the previous slide that population growth is going to keep falling. And therefore, it's going to mean the debt to GDP keeps rising. There is no stopping this train, as Lynn Oldham will say. So that's the issue we have to deal with, this global debt. And debasement of currency has been the way of it. So debt to GDP, even if we just look at the main chart, we can see probably by like 2030 or so, we're at 160% of GDP, 140%, and we keep going. We keep going because there's no way around this population cliff until the AI and the robots take over as population. New demographics. Robots are demographics. But until then, we're stuck in this trap. And we're starting to see the signs of that yet again, where the Federal Reserve have to go back to the balance sheet to start thinking about how do we monetize all of this debt. And that is the whole process. This chart is a very important chart. It is the Fed net liquidity, or we could use total liquidity in the United States. And it basically is offsetting the debt. So the debt is offsetting the population shrinkage or the labor force shrinkage, and we are printing money to service the debt. That is the whole game. You see, the private sector and the public sector are both over 100% of GDP in debt, and so it takes up all of the GDP just to service the debts of one of those sectors. The government is the one that ends up either on the balance sheet or via printing of money through the banking system or other mechanisms. This is the debasement of currency, the mega trend.
The hardest part of this cycle is not analysis. It's patience. Crypto is not broken. The cycle is not over. The macro forces are not bearish. We are simply in the uncomfortable middle where liquidity hasn't fully arrived yet. But history is clear. When liquidity flows back into the system, crypto doesn't just recover, it leads. This is not about hope. This is about math. And math says, we can still have nice things. If you understand the cycle, stay patient, and ignore the noise, the next phase may be the most powerful yet.